Welcome to your weekly macroeconomic outlook. We cover the key macro and financial market developments across 6 major global economies. In the United States, the economy continues to show resilience despite growing pressure on consumers. Job growth exceeded expectations in April, unemployment remained steady, and consumer credit posted its strongest increase since 2022, indicating households are relying more heavily on borrowing. At the same time, executives across major retail and restaurant companies report that consumers are becoming more cautious as savings buffers are depleted. Consumer sentiment also deteriorated, highlighting increasing concerns about the cost of living. Inflation remains the key macro risk. Higher gasoline prices are disproportionately affecting lower-income households. Productivity growth slowed in the first quarter, and unit labor costs accelerated. Bank of America has recommended shorting 2-year U.S. Treasuries, citing the risk that elevated oil prices and resilient economic activity could force the Federal Reserve System to maintain a more hawkish stance. Market pricing now reflects a meaningful probability that the Fed may need to raise rates again before it can resume easing. On the policy front, the U.S. trade deficit widened modestly in March, while the Treasury signaled no changes to its medium and long-term borrowing plans. Meanwhile, courts ruled that President Donald Trump's 10% global tariffs were unlawful, prompting the administration to begin refunding tariff revenues. Ultimately, we remain pro-equities in the U.S., particularly tech stocks, while advancing shortening duration.
China's economy continues to present a mixed picture. Stronger than expected first quarter GDP growth appears to have reduced the urgency for additional fiscal stimulus, with broad government spending falling 2.5% year-over-year in April, even as fiscal revenues rose 3.4%. At the same time, export momentum strengthened sharply, with April shipments rising 14.1% year-over-year, well above expectations, as global manufacturers rushed to secure Chinese components amid concerns that the Iran conflict could push input costs higher. Despite robust external demand, domestic conditions remain subdued. New bank lending is estimated to have dropped to just 300 billion yuan in April, highlighting weak credit demand despite policy support from the People's Bank of China. This suggests that business and household confidence remain fragile, and that the recovery is still heavily dependent on exports and state-led investment, rather than a sustained rebound in private sector activity. China is also facing rising geopolitical and regulatory pressures. The European Union is considering restrictions on Chinese suppliers in energy infrastructure projects, while Beijing has directed domestic companies to ignore certain U.S. sanctions in an increasingly assertive stance ahead of President Donald Trump's upcoming visit to Beijing. Meanwhile, the rollout of China's AI-powered Golden Tax 4 system is tightening tax enforcement, increasing compliance risks for both domestic and foreign firms. Overall, China's near-term outlook remains supported by strong exports and policy flexibility, but weak credit creation and ongoing geopolitical tensions underscore persistent structural challenges. For investors, this backdrop favors selective exposure to export-oriented manufacturers, technology, and infrastructure sectors, while maintaining caution toward domestically focused businesses that remain constrained by soft demand. The euro area continues to face a more challenging macro backdrop as the Iran conflict drives up energy prices and intensifies stagflation risks. European Commission Economy Commissioner Valdis Dombrovskis warned that higher energy costs are pushing the region toward weaker growth and higher inflation, while International Monetary Fund has suggested delaying repayments on joint pandemic-era debt to create fiscal space for defense and infrastructure spending. Within the European Central Bank, policymakers are increasingly alert to upside inflation risks. Wage growth is expected to accelerate in the second half of the year, and officials, including Isabel Schnabel, have indicated that a sustained inflation impact from the Iran war could warrant further interest rate hikes. At the same time, governing council members such as Gabriel Makhlouf and Yanis Stornaris have cautioned that recession risks are also rising. Structural reform remains a central priority. The ECB noted that financial integration has improved in debt and banking markets, but equity markets remain fragmented, limiting Europe's ability to channel savings into productive investment. Officials see deeper capital markets and growing private market financing as essential to modernizing the economy and improving competitiveness relative to the United States and China. Trade uncertainty adds another layer of risk.
President Donald Trump has delayed new tariffs on European autos, but warned they could rise sharply if a US-EU trade deal is not finalized by July 4. Meanwhile, German banks are holding substantial excess capital, but remain cautious about lending amid weak demand and geopolitical uncertainty. For investors, the environment favors high-quality European equities with pricing power, inflation-linked bonds, and selective exposure to sectors that stand to benefit from increased defense and infrastructure spending.
Canada's economy is showing increasing signs of strain as labor market conditions deteriorate. Employment has fallen by 112,000 jobs so far this year, including a loss of 17,700 positions in April, pushing the unemployment rate up to 6.9%, the highest level since the pandemic recovery period. The weaker labor market suggests that higher interest rates, trade uncertainty, and slower domestic demand are beginning to weigh more materially on economic activity. Despite softer growth, there are pockets of resilience. Canada recorded its first trade surplus in 6 months in March, with a $1.8 billion surplus driven by stronger exports of oil and gold amid heightened geopolitical uncertainty. Toronto home sales also posted their largest monthly increase in 9 months as lower prices attracted buyers back into the market, hinting that housing activity may be stabilizing after a prolonged downturn. Structural and policy developments remain supportive over the medium term. Prime Minister Mark Carney is considering monetizing stakes in major airports to fund growth-enhancing infrastructure projects, while a proposed Alberta to Wyoming pipeline could boost Canadian crude exports to the United States by more than 12%. At the same time, Canada is designing a quota system for lower-tariff Chinese electric vehicles to encourage greater competition and improve affordability for consumers.
The United Kingdom is facing a more difficult macro environment as higher energy and input costs linked to the Iran conflict begin to weigh on growth and inflation. Business surveys show firms are raising prices at the fastest pace in more than 3 years, while construction activity fell sharply in April, with the S&P Global Construction PMI dropping to 39.7, signaling a significant contraction in the sector. The apparent resilience seen in some recent economic data is increasingly being questioned. Officials at the Bank of England have expressed concerns that stronger headline figures may overstate the economy's underlying momentum, complicating decisions on interest rates. With inflation pressures intensifying even as activity slows, the Bank of England faces a classic stagflationary trade-off. Political uncertainty is also rising. Prime Minister Keir Starmer is under pressure after substantial local election gains by Nigel Farage's Reform UK, highlighting growing voter dissatisfaction with the government's economic management. Meanwhile, the FTSE 100 has underperformed other major European indices, weighed down by falling energy shares and its limited exposure to technology stocks benefiting from the global AI rally.
Japan remains focused on protecting its industrial competitiveness and stabilizing its currency amid a challenging external environment. Economy Minister Ryosei Akazawa has urged the European Commission to revise proposed industrial legislation to ensure it does not hinder cooperation with Japanese firms in key sectors such as automobiles and battery technology. In financial markets, the Japanese yen has struggled to sustain gains despite repeated interventions by authorities. The currency remains near $155 per US dollar, reflecting continued demand for dollars, elevated energy import costs, and the relatively accommodative stance of the Bank of Japan. Bloomberg estimates suggest Japanese authorities may have spent roughly $30 billion over several days to support the yen, underscoring the scale of official efforts. However, intervention alone is unlikely to deliver a lasting turnaround. Without a more decisive shift toward tighter monetary policy by the Bank of Japan, any strengthening in the yen is likely to prove temporary. Markets increasingly view intervention as a tool to slow excessive volatility rather than establish a durable exchange rate level. For investors, Japan's outlook remains broadly constructive, supported by ongoing corporate reforms and resilient earnings, but currency volatility remains a key consideration. Export-oriented equities continue to benefit from a weaker yen, while any future policy normalization by the Bank of Japan could provide support for the currency and domestic financial stocks.
If you enjoyed this content, please support by clicking the like, share, and subscribe buttons. Cheers, and see you next week.